Hey guys, Michelle Kinney here. Thanks for checking in. Thanks for checking out my video. I'm going to make a quick video now on selling a covered call. I've done a bunch of videos recently on selling a put, and sometimes people say, okay, that's great. And I get that part, but what happens if I have to buy the shares? Or what happens if I already own stock and I want to sell a covered call against it? Or what happens if I want to I don't have any stock right now, but I want to buy some and I want to sell a call against it? How does that all work? I'm going to walk through a trade and I'm going to use my own trades that I had last week as an example. I'm going to show you my trading platform live. I'm going to show you my trades that I did on this particular stock. And I'm going to walk through all the details A to Z. Stay until the end because you're going to learn so much amazing stuff. So this video I'm going to do on Tesla, right? Tesla is one of my favorite stocks. I love Tesla. I've been trading Tesla for, I don't know, years and years and years. First thing I do when I look at a chart is or stock rather, is I look at the chart. Where has it been over the past year? Now, this is my trading platform. This is Thinkorswim. And this just kind of shows you each tick is one day. A green tick is an up day. You don't necessarily have to know that. And a red tick is a down day. But this just kind of shows you visually where Tesla trades. And Tesla has some volatility. I like stocks that are volatile because they give you an opportunity to make money if it's going up, make money if it's going down, make money if it's sideways. Here's the thing. I'm going to tell you in this video how to choose the stock, how to choose the strike price, how to choose the expiration date, how does the whole thing all work, what kind of rate of return do you get, how do you calculate that? I'm going to tell all of you that, and I'm going to use my own examples on recent trades that I had last week in this particular stock, right? So first of all, when we talk about choosing a stock, a lot of times people will ask me, Michelle, what kind of like stock screeners do you use? I mean, you can Google stock screeners and there's so many of them out there. There's free ones or there's ones that you pay a subscription for. I don't use stock screeners. I just trade the same stocks over and over and over again. Why? Because I get used to how they behave. It's kind of like cooking. Like I like to cook. I'm not really a chef or anything, but I do enjoy cooking and I cook certain things pretty good. I love making breakfast as an example. And when I make breakfast, let's say I'm making an omelet or something, I don't have to, let's say, measure the ratio of the onions and the peppers and the mushrooms and the whatever. I just kind of like eyeball it because I just have been doing it and doing it and doing it for so long. I know how it tastes, how I like it, and I just kind of do it based on memory, right? When I cook it, the omelet in the pan, I don't have to set a timer on my phone. I just kind of eyeball it because I know how I just have a lot of experience and I know how it comes out. Trading stocks is the same thing, guys. Once you get the hang of trading the same stock over and over again, you just get used to it. You get used to the ups and the downs. You also get more comfortable and more confident. Now, I don't talk a lot about confidence, and lots of people don't talk about a lot about confidence on YouTube videos, but I'm going to share a couple things. Confidence when you're trading is very important because you want to look at trading as a business, a means to just create income for yourself. When I trade options, I'm doing it for two reasons. Number one, I want to create a systematic, steady stream of income for myself to sustain my beautiful lifestyle. I have stuff that I want to do, pay for on a week-to-week basis, obligations or fun stuff that I want to do, and I need money to do that. So options gives me that money on a week-to-week basis because I personally sell weekly options. We're going to talk about the expiration dates in a moment, and I'll get to that more. But I sell weekly options, and the second reason why I trade options is because I want to just like spend 20 minutes on trading, let's say, every day. And then I want to spend the rest of the day doing the stuff that I want to do. I don't want to look at stock screeners all day. I don't want to like look at like, oh my gosh, let me look at this stock. Let me look at that stock. Let me look at that stock. Can become overwhelming. I've learned in life in general that you don't want to be overwhelmed. Things are easy and they're repeatable when it's like very simple things that are done over and over and over again, the same sorts of things. So all I do is I sell puts and I sell calls, and I do it on the same stocks over and over again. I just have a handful of them, and sometimes like I'll trade one for a little bit and then I won't trade it for a little bit of time for whatever reason, and I go back. But Tesla has always, for many, many years, been my go-to. So I'm going to use Tesla as an example, and I'm going to show you in this video, stay until the end, I'm going to show you in this video my trades and how to calculate that, and I'm going to show you all the details in between. So let's say, actually, let's start with my trades, right? Now, I'm going to show you my Tesla trades that I set this up before this video. from last week, right? So today is the 21st of September. The market's not open because it's Sunday. The market's open tomorrow. I bought Tesla on the 18th. I bought 100 shares and I paid $431.06 per share. I didn't sell a put. I do that also sometimes, and sometimes I just straight buy the stock. So I'm just going to give you the example that I had personally last week. I bought 100 shares of Tesla at $431 per share. Right after I bought those shares, I sold a 432 call that expired 9/19. It was that Friday. So I bought 100 shares of Tesla on Thursday, and then I sold a call against it on Friday, one day, and I made $575. Now, the price, remember, just like the video I did yesterday on selling a put, anytime we look at a price of an option, we multiply by 100. Why? Because there's always 100 shares in one particular contract. So if I sell one contract for 5.75, that means $575 got dropped into my account right then and there. Now, how do you know how much you need to make the trade? Let's talk about that as well. Well, if I put up all the money, I have to put up that amount per share times 100 times the amount of shares that we're buying, right? So let's say I couldn't do that in my head. This screen does it for you. But let's say before we do the trade, I just want to estimate that 431.065 is what I paid times 100. So I paid the value of the shares was $43,106. You can see that right here, right? And you can see this right here, 575 less the fee and commission. I'm not going to talk a lot about commissions, but I'll just say this is that every time you put a trade in, it's got a small commission. So in order to sell this particular contract, I paid a 51-cent commission to the broker dealer, right? So this was my net that got dropped into my bank account. Now, what does that mean when you sell a covered call? Here's what that means, guys. Let's go back to Tesla. Tesla right now is down, by the way, 426.07. I paid 431. Am I freaking out? I'm down $500. No, I'm not freaking out. You know why? Because I know that stocks go like this. They go up and they go down. They have volatility. That's why I like them. Volatility lets me make premium on them from a week-to-week basis. The $500 that I'm down is a paper loss unless I was to sell my shares. I'm not going to do that. Too many people freak out when their stock goes low. They sell their stock for less than what they paid, and then they recognize a loss. Don't do that. If you don't do that, you're not going to lose money. I'm telling you, that's just the way it works. So right now, Tesla's 426.07. Let's go back to what I did, right? I sold the call right after I bought those shares, and I did it for an expiration date for the following day. That was last Friday, the 19th. That was this past Friday, right? I got paid $575. If you calculate the rate of return, I got paid $575. Let's say I didn't use margin. I did because I use margin in my account personally, but let's say you want to be super conservative and you don't want to use margin. Well, in that case, you have to put up this amount of money, right? $43,106, right? That gives us a rate of return of 1.3%. But remember, guys, that's only for one day because I sold the option on 9/18. That was Thursday with an expiration date of 9/19. That was Friday, right? One day. So how do we calculate the annualized rate of return? First of all, take a step back. We always want to compare apples and apples. Just like in the video I did yesterday on selling a put, we compared apples and apples. We annualize our premium out. It's not that hard. You don't have to be a math guru or physics major or anything like that. You just have to listen to this and have interest and drive to change your life, and then just listen to it over and over again and practice. That's all you have to do. Practice makes, not perfect, because I don't believe in perfection, but practice makes things easily to be successful. So this is my rate of return for a one-day period, right? How do I annualize this? Well, I know that there's 252 trading days per year, right? So I'm going to multiply it by 252, right? That gives us a 336% annualized rate of return. What that means, guys, is if I was to do a trade like this all the time on an ongoing basis, this is the amount of money I'm making per year. But I don't really count on making 300% per year. I usually use 100% as a really good metric. If I'm making 100% or more, I'm happy. But on this particular trade, if I annualize the rate of return out, it's a 336% annualized rate of return, not using margin. I'm going to talk about margin in a moment again. I don't want you guys to focus on that. I want to talk about selling a covered call and how you can make money over and over and over again and change your life. Now, here's what I did. Friday on the 19th, while the market was open. Now I could have waited until the contract expired, but what I did was I bought it back, the contract, for 40 bucks, right? So you see 0.4. Why is it $40? Because 0.4 times 100. Why did I buy it back? Because what I did was I do this. So sometimes I wait until the contract expires. Sometimes I buy it back and then I sell another one. I just want to keep flipping my money over and over again. It's kind of like the guys that flip houses, right? You buy a fixer-upper, you fix it, you flip it, and then you do another one, and you do another one, and you do another one over and over and over again. That's how I get a better rate of return per year. And I live off of my money. So I don't have a regular job. I don't have a 9 to 5. I feel blessed and grateful every morning that I wake up. I spend about 20 minutes a day on this stuff, other than doing these videos on trading. I don't look at stock screeners, right? I don't look at like charts all day. I just do the same things over and over again. You can do the exact same thing that I'm talking about. So getting back to my example, I sold this contract for 575. I bought it back for 40 bucks. What does that mean? That means I netted, and we're not going to talk about commissions because it's negligible. I netted $535 on this trade. This isn't, listen, the people that I want to buy some stock or I want to trade some goofy mutual funds, and then I want to wait and hope and pray that that stuff goes up and then sell it and then make money. No, I don't live my life like that. I want to make money week to week. So I netted on this particular trade $535 over a 2-day span, 9/18 to 9/19. Right after I bought that contract back, I sold another one for this coming Friday, 9/26, right? How much did I get paid? 800 bucks. Why 800? 8 times 100 shares is $800. Here's my net right here because that includes the commission, a few cents. So let's go back to our trading screen. You see how easy it can be. So going back to my trading screen, let's take a look at, let's say you didn't have this, right? You're starting from scratch. You're looking at this video, you're getting all excited. You don't have any stock or something like that. And you say, okay, I want to buy 100 shares. I want to teach you guys how to pick the stock, how to pick the expiration date, how to pick the strike price, right? That was my example that I did. Here's how to pick the stock. I kind of told you before, I just trade the same ones over and over and over again. You kind of just get in the groove. It's kind of like I walk to the gym in the morning. Do I need to take my phone out and put Google Maps in to know how to get there? No, because I'm walking there all the time. I kind of know what time to leave. I don't have to set my alarm and leave at a certain time. I just kind of know because I've been doing it over and over again. Trading stocks in the same stock over and over again is the same thing. So that's how you choose the stock. Choose something that you're familiar with. I don't know. Do you use an iPhone? I use an iPhone, right? I'm using a MacBook. Apple. When I first started trading, I traded Apple a lot. It was like my go-to because, Apple is a super strong company. I don't know about now, but at the time, many years ago, it had more money than the federal government in the US had. It was super strong. Was it ever going to go out of business? I mean, obviously, there's always an opportunity. There's always going to be risk in the market, but the risk was very, very, very small. What you want to do, guys, you want to identify what the risk is and understand it. And is that a risk that you're willing to live with? I like Tesla. I like Apple. I like, different stocks. I feel comfortable that the stocks that I'm trading aren't going to go out of business tomorrow. Will it have volatility? Yeah. But as long as I don't panic and sell when it's low, I'm good. So that takes care of picking the stock. Let's go back to picking the expiration date. So here's my trading platform. I'm going to show you with all my stuff. I'm like an open book here. So as you can see, this is Tesla, right? As you can see, it's got expiration dates every Friday. So September 26th is this Friday, October 3rd is the following Friday, October 10th is the following Friday. Now, if I look at me personally, I have a 432.50 call, right? So let's see, 432.50 calls are going to be on the left-hand side. We'll go down the middle for the strike prices, and we're just going to move over. That contract closed at $9.10, right? So now remember, I'm going to talk about a couple things. Number one, I sold this contract on Friday, and I got paid 800 bucks. Now, right now, it's trading at $910. What does that mean? That means, first of all, I'm down a little bit of money on the stock because I paid 431 for it, and now it's 426, right? So I'm down about 500 bucks on the stock, but it's a paper loss. I don't care about paper losses. And on the option contract, If I was to buy back this contract right now, I would buy it for more than I paid. I'm not going to do that. That is also a paper loss. It means absolutely nothing to me. What I'm going to do is I'm going to wait till time goes on. And if I wait until Friday, here's what a covered call means, guys. Basically, you're paid a premium. In my case, I was paid 800 bucks. I'm committing to sell my shares at 432.50. If the price goes over that strike price, 432.50, by the time the contract expires. The expiration date is September 26th. If it doesn't go higher, I don't sell my shares, and then I sell another call next week. I just keep like rinse and repeat, 800 bucks, cha-ching, cha-ching, cha-ching. And that's what I live off of, like trades like that, right? So let's calculate our rate of return. So I think I already calculated it if I put up all the money, but let's calculate, forget about my example. Let's say you want to do an example like this on Monday. Now, just to make sure we're clear on all this, I'm not giving you investment advice. I'm not telling you what to do. I'm sharing what I'm doing and how much money I'm making from it and how much money you can make from this type of thing. But ultimately, whatever trading decisions you make is your decision, right? You're in charge of your own destiny, not me. I'm just educating you online. But let's go to our platform here now. Now you can do one of two things when you buy shares or when you trade in general. You can have all the money to put up, or you can use margin, right? What's using margin? Margin is you're using some of the bank money. So why use your money if you can use some of the bank's money? I like using margin. And I have lots of other videos. I'm not going to talk too much about margin. I'm just going to tell you the basics of what it is. I do have lots of other videos online that go into more detail on how margin works, because if you are using margin, you do want to understand it. Because you don't want to, let's say, have a margin call, right? You don't have enough money in your account, the stock goes against you, you have to put more money in. And if you don't have enough money to put in, they break your trade and then you recognize the loss. So you don't want that to happen. So watch some of the other videos I have online if you're using margin. But I'm going to give you an example on how do I know how much money I need if I want to make this trade and if I want to use margin. Well, the easiest way to do that, this particular platform, this is my platform, Thinkorswim. I'm going to click on the price of the stock and I'm going to click buy, right? It brings up this order entry box. This is very similar to the video I did yesterday on selling a put. A lot of these fundamentals are going to be the same, except this is a covered call. So you're going to see I'm buying 100 shares of Tesla. It shows you the price. We're not going to talk about the limit the limit types. I have other videos that talk about that. But if I want to buy Tesla, let's say when the market opens, and replicate what I did, let's say last week, I'm going to see how much margin I need. I'm going to right click and I'm going to go to analyze trade. And this will pull up a box right here. And this shows you unallocated plus 100 shares, Tesla, and it shows you what the margin requirement is, right? So this margin requirement is 12,771. Now, if you had to put up all the money, if I had to put up all the money, it's $42,600, right? And if I can't calculate that in my head, I can just calculate the stock is trading at 426 a share right now times 100 is $42,600. But if I want to use the bank's money, I only have to put up a little less than 13,000. Now, if I put up 13,000, what's my rate of return? Well, let's calculate that. Right now, this particular contract, I sold it for $800 on Friday, but right now it's going for 910. So it's going for a little bit more, right? So we're going to divide 910 divided by 13,000. I think it was 12,000 something, but we're just going to round it off. What's our rate of return? Well, that's 7%. But if I put this trade in on Monday and the expiration date is Friday, we're only holding it for 1 week, right? So we're making 7%, but for 1 week. So what am I going to do? I'm going to multiply by 52 because there's 52 weeks in a year. And now that gives us a rate of return of 364%. Do you see how easy this can be? So many people tell me so many things that make no sense on a regular basis. And this is one of them. People say, oh my gosh, you're out of your mind. You don't make 100%. You don't make 200%. You don't make 300%. I'm showing you in black and white that you can absolutely make 364% on your money. Now, Tesla is a higher price stock. So you might say, Michelle, I don't have $42,000. I don't even have $13,000. I have $5,000. I have lots of other videos on this channel that show you how you can do the same exact thing. The principles, listen, guys, These principles of selling options are the same, whether you have $5,000 to start, $10,000 to start, $100,000 to start, $500,000 to start. The only difference is if you don't have a big account, you probably can't trade Tesla because it's too expensive of a stock. Okay, trade Ether, trade, I don't know, Sophie, trade. There's lots of other things that you can trade. Again, I'm not making recommendations. I'm just telling you, trade something with a lower dollar value. But I want to give you this example on Tesla because it's my absolute favorite stock. So anyway, let's break it down. We talked about a little bit about expiration dates, but I didn't get detailed. So let's get detailed. So again, you can choose lots of different expiration dates. Now, let's say I buy Tesla and I'm working a 9 to 5 job and I don't want to trade every day 20 minutes a day because I just don't want to take the time, or I don't have the time. Maybe you already have shares of Tesla. Maybe you have some garbagey kind of mutual funds that you're not making that much money from that you can sell that nonsense and buy some Tesla or something else, right? So let's say if I go out a little bit longer, I just want to illustrate how easy this is to learn and how these numbers kind of correlate with one another, right? Let's say if I don't look at 1 week, but let's look at, I don't know, let's look at March. I don't know, what's that, 6 months away or something. Well, if I look at March as an example, and I go to 432.50, well, first of all, there's no 432.50, right? So strikes are down the middle. It goes from 430 to 440. Like I said before, and I said this in the other videos, the increments depends on not just the stock, but also the actual contract. So if I look at short-term contracts, they're increments of $2.50. But when I look at longer-term contracts, they're $10 increments. So I could not sell a 432.50 because it's not available, right? If I don't see it on my screen, it's not available. But I can sell a 440 call. So what does that mean? Let's just break that down and give you guys an example, right? So let's say I want to buy Tesla tomorrow at 426 per share. That's where it is right now. And then I want to sell a 440 call that expires March 20th. So that's about 6 months away. How much is that going for? Oh my gosh, that's going for 66.5. Well, what does that mean? I multiply by 100. Remember, anytime we look at the price of an option contract online, we're going to multiply by 100 because there's 100 shares of stock in each contract. This means if I was to make this trade and go out longer, 6 months, I'm paid $6,650. Guys, you can tailor options trading for whatever your particular scenario is. Maybe, like I said, you work a 9 to 5 job and you don't want to look at this stuff all the time. You just want to look at it like every once in a while. You don't want to like fuss about it. Well, here's what that means. This is a guaranteed amount of money that gets dropped into your account right then and there. Now, let me explain to you what I mean by that because it's so powerful and people just don't understand it for some reason. And again, you don't have to be smart. You don't have to be good in math. You don't have to have graduated high school to understand these concepts. What do you have to have? You have to have an interest in this. You have to be interested in what I'm talking about. You have to have a little bit of money to start, right? You don't need, let's say, 40 grand to trade Tesla. You can trade a different stock. You have to have a little bit of money to start. And you just have to just keep watching these videos over and over again. This means I can buy 100 shares of Tesla. I can either put up all the money or I can use some of the bank's money. I can sell a call right away against it, a $440 call. What that means is I'm committing to sell my shares. If the price goes over 440, it probably will because there's a lot of time. And if we look at the delta gives you the statistical likelihood that that is going to happen. So it's not like a black and white number, but it gives us like a general gauge, right? How likely it is versus not likely. Well, it's about 57 is more likely than not, 57% likely that Tesla will be 440 or higher in the next 6 months. It's a 6 month time frame and it has a lot of volatility. And over time, Tesla goes up. So it's more likely than not. We make $6,650. Now, what's our rate of return then? I don't know. Let's just calculate it. I don't know. I didn't even do this before this video. 6650 is our premium. Let's say we have to put up all the money, right? We don't want to use margin. I'm going to put up $42,600 because it's 426 per share. You see that? Now I'm making 15%, right? But I'm holding this for 6 months, or I'm committing to hold it for 6 months. You could get out early at the market, which might be more or less than what you originally got paid in premium, but it's a 6 month contract, right? So if I'm making 15% for 6 months, right? Now I'm only making like 30% per year. So I don't really like to go out long out. First of all, I don't think the return is good. Why make 30% when I can make 100% or 200% or 300%? And also, I don't want to lock in my money for 6 months. Like, what if I buy Tesla, sell this contract, and then Tesla starts dropping? If that happens, this is going to be more expensive. So I'm going to kind of get like, I'm not going to get in the weeds, but I can kind of get stuck into that trade and not be able to do anything. So me, I like flexibility. I like choices. I like options. I like options, 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 right? So I like to do 1 week contracts. So, but you could do, 6 months, 1 month, 2 weeks, whatever. So here's what we talked about so far. We talked about choosing the stock. Now we talked about the expiration date. Now let's talk about the strike price. Let's do that briefly. So I'm going to look at 1 week because that's my favorite, right? I bought the shares at 431, right, on Thursday, right? I talked about selling a 432, a 432.50 call, right? And the reason I chose a 432.50 call is because I bought the shares for 431. Me personally, I want to make as much money on premium as possible, and I don't care so much about the gain on the actual stock price. The reason why is because premium is like guaranteed income in your pocket. Like, I would rather have like a guaranteed $5 today than a possible $6 or $7 tomorrow. I don't know. Maybe you're different, but that's what I prefer. I prefer to have a guaranteed amount of money every single week. So this works for me. If I wanted to go higher, I could though. Let's say I could go 440. Let's say I want to sell a 450 call. Let's say I love Tesla and I want to keep my shares and I'm married to them. I never feel that way because I think that's goofy. But let's say you're different and you want to sell a further away strike price. Well, you see, a 450 call is going for a little bit less. That's only going for $425. You're going to get paid less money, right? So here's what I do, guys. And this is good. And what I do might not work for you. Again, trading options is kind of like a dance, right? Like, you're going to find your groove as you go. And what works for me might not work for you, but this works for me. And this allows me to not work a 9 to 5 for many, many, many years, to do whatever I want, whenever I want, with whoever I want. And it's a beautiful, blessed life. And you could do the same thing. So going back to my example, I choose something that's super close, a little bit higher than what I paid. If I paid 431 per share, I'm going to choose a 432.50, and I'm going to choose next week. Short term, at the money, closest to the money as possible. I never sell a covered call for less than what I paid on the stock. Why? Because that would mean if that were to get assigned, I'm going to be losing money on the shares. All my trades, my intention is realized gain, don't lose money. I think Warren Buffett says, what's the number one rule in investing? Don't lose money. What's the number two rule? Don't lose money. Refer to rule number one. So yeah, so that works for me. And that's been working many, many years. And I've been doing this in all market cycles. Market goes up, market goes down, market stays sideways. These are fundamental, time-tested, sell a put, sell a covered call. It is that easy, guys. Anyway, I think I talked long enough. I hope this video helps. Let me know in the comments, what do you think about selling covered calls? What's your favorite stock? Tell me about a stock and I can maybe make a video on it. I have a really great live event coming up. I'm going to start doing more live events. I love talking about this stuff. It's my passion. I don't know. Somebody said, I don't know who it was, but if you do for work like what you love, you never work a day in your life. I love options. I think it's an amazing thing. No customers, no employees, and you can do it from anywhere in the world, and you can make yourself money on a regular weekly basis. So anyway, I have a live event coming up. If you guys haven't traded before, or you want to trade better, if you want to like have the opportunity to have live Q&A with me personally, it's only $49. I don't know. I figured, let me just do some cheap live event and get a whole bunch of people like super stoked about trading options. So I'm going to have the details in the comment section below. If you want to join me, that's amazing. And I hope this video helped. Cheers for now.